And there you are. Good afternoon, Crystal. How are you, ma'am?
I'm fine. And yourself?
I'm doing great. I'm going to see if I can turn your volume up just a little bit.
Okay. Can you hear me now?
Yes.
Okay. All right.
So, although let me turn it up just a little bit more here. Let's do like this. Okay. So, as always, I'm excited about this particular broadcast, particularly because you gave me a really awesome article to review. I'm not going to say the name of where it came from because they may not want me to do that. But it is an article about putting different types of investments inside the 401k plan. It's a great topic. We've been around for a long time with that topic, so I can't wait to jump into it with you. And first of all, though, let's. I'm going to be a little bit unprepared here. I'm going to get your bio, read that, and then we can jump into the topic. How's that?
Sounds good.
Okay. Okay, well, that was horribly unprofessional. Well, try to make up for that. Okay, everyone. I'm Jevon Thomas with Jevon Thomas Retirement Plan Consultants, and joining me is Crystal Mitchell. She is a business coach and consultant. She's the CEO of Mitchell Business Solutions. Crystal is also the co-director of Recycling Black Dollars. She's the co-host of The Business Zone with Crystal and Gilbert. It's another weekly online radio show. She's an instructor at Mount San Antonio Community College, a certified network for teaching entrepreneurship instructor, and a QuickBooks Pro Advisor financial strategist. And I'm having a little bit of a problem here with LinkedIn, so I'm just going to let it go.
Okay.
I'm gonna let the LinkedIn go, and we're gonna proceed forward. Let's see. Yes, here we go. Okay. So for those of you that are unable to see us, I'm so sorry. But LinkedIn has decided not to play with us today. So we'll put that on YouTube and hopefully get that on LinkedIn when we're able to record it. But anyway, let's jump into the article that you sent me. It's an article about the White House starting to use investments outside of the typical mutual funds that they use in regard to 401k plans. Have you had experience with that?
I know that there's been much conversations about putting crypto in inside of 401k, which I think is, in my opinion, kind of disastrous. They haven't convinced me that crypto is not a pyramid scheme. I'm sorry. From an accountant standpoint, the logic doesn't fit for me. Because it's not there's nothing tangible to it.
Right.
So
well,
that's my problem.
That's a fine opinion. I happen to share that opinion. But I also realize that investments are all based on who wants it and who wants to sell it. So from that point of view, if you have someone who wants to buy, then you're at the basis of the markets. It's all about buyers and sellers. So we have the advantage in the regular market, if I can call it that, on the New York Stock Exchange and things like that, to suggest that, hey, if a product is needed, it will make more money, and that will generate more money for the company, and that will generate a better stock price eventually, especially if we're looking at dividends and what have you. So is it something that we should invest in or not? That's the question.
Yes.
If you talk to my friends who sell crypto and who live by crypto, they say, it's all a Ponzi scheme. It's all about smokes and mirrors. and Americans haven't woken up to that. The problem with that is we don't have near the volatility that crypto has. And we have something that we kind of understand, whereas with crypto, most of us just don't. Okay, so taking that premise, with crypto, most of us don't understand that. And with long-held beliefs that so many of us understand, that is working with the exchanges, let's jump into this topic, which is the article was the White House makes risky changes to retirement accounts. Again, please don't send me your letters. Thank you for sending me this article. And I hope I don't misquote it. So here we go. What is the deal? Well, it's an age-old problem. And I remember when ETFs had pretty much the same kind of discussion. So this idea of letting quote unquote alternative, and when I say, let me define that. When I say alternative investments, I mean investments outside of mutual funds, stocks, and bonds in your portfolio. So the issue has been, we can make more money, have more opportunities to make more money if we get away from having to stick with mutual funds or and open-end funds that anyone can buy them. We can make more money if we vary the types of investments we can get involved in. So we're talking about typically alternatives, ETFs, oil and gas, options, crypto, all kinds of alternative investments.
Okay.
Yeah. The reason I have a problem with that is I'm going to go out on a limb and suggest that most of us that sell 401ks, qualified type plans, we understand what those plans are, those other outside of the market, outside of 401k options are. The problem is we don't get enough people saving. So we're thinking it's not really a question of, do we not have enough investments? It's a question of our mentality with regard to when do we start saving for retirement, which ought to be in our 20s, right? So to your point, with regard to crypto being sort of loosey-goosey and not really nailed down, you're right. It doesn't fit the normal thing that you would think with regard to stocks and bonds. That is, goods come in, we make a better mousetrap, we sell more product, we do better in the market, we're able to offer more dividends, we're able to reinvest, we're able to do all those kinds of things that we do when we try to improve the process. Those things may apply to crypto. I don't see it now, but they may apply to crypto. Instead, we have huge amounts of volatility. One of the interesting things that I saw about the article that you sent me, and I believe I sent it to you on the notes, was number one, this is a potential. It's not a foregone conclusion. So that's number one. It's a potential loosening of the types of investments that we can put into 401k plans. Why is that important? And I think the number one reason why that is important is what I sent to you in the well, I don't know if you were able to see the pink lettering.
I did.
Is what I sent to you. And that was that typically, especially when you're talking about a small plan, the major client, the person who's actually suggesting the plan, who's actually putting up the fees most likely for the plan, is the business owner. And indeed, when I sell retirement plans to folks, I want to make sure that the business owner is getting a return on his investments. And that means that the plan is being used as a way to recruit, retain, and reward participants. All right. So if the plan doesn't help the business become more successful, help the business owner do the 3 R's, then is it really a good plan? And I would say no. Right? So, but the key word there is business owner. So the real reason that financial advisors typically like these products that are outside of mutual funds is so that the business owner can get more diversification, hedge against inflation, get a better, more robust platform. Okay. The business owner, the highly compensated, but specifically the business owner.
Okay.
That's incredibly important because, and then I'll let you talk. That's very incredibly important because it's an employee benefit. It's not a business owner benefit. So the business owner is able to take advantage of the employee benefit, and God bless them. They're running the company. They're making the decision. They're footing the bill. But the Department of Labor set this up after this loophole called 401k was discovered. Once that was discovered, it became an employee benefit, not a business owner benefit.
Right.
An employee benefit that business owners get to take advantage of. And the rules about that were, if we're going to give employees this benefit, we need to let them know how to use it. Thus, my job was created, retirement plan advisors, right?
Right.
If we're going to teach employees how to use it, one of the big tenets of that is get in the plan, right? So I'm coming from the point of view of, I can't even get employees to get in the plan. Right? I can't even get them into the plan in their 20s and 30s, because if we could get employees into the plan in their 20s and 30s, saving 10, 15% of their income, we wouldn't have an issue with people reaching retirement age and not having money.
Right? Yeah, right, exactly.
So it's like we're kind of barking up the wrong tree to get to the wrong answer, in my opinion, in my not so humble opinion. We're going after the ability for business owners and highly compensated employees, perhaps, to diversify their portfolio for all good reasons, but we're using an employee benefit to do that. That particular employee benefit isn't necessarily benefiting the employees in as much as it would if they could start contributing earlier. So instead of changing this so that business owners can make more money, these are people that have assets who can invest outside their plan, who have the option for a self-directed brokerage account, which means they can carve out some monies that they can invest outside of the plan in anything that they want, crypto, whatever. They can do that. They can already do that. They pay a fee to do that, but they can already do that. In some cases, they can already do that. Instead of, we want to do that instead of teaching employees, hey, get into the plan in your 20s, at least by your 30s, but in your 20s, start putting 10% of your paycheck away. And then by the time you reach retirement, you don't have to worry about having money in your plan. You don't have to worry about a diversified portfolio, because we're going to talk with you about that. You don't have to worry about an inflation hedge, because we can put that stuff in. You're going to have a robust platform. So that's what I have to say. What do you think?
I think you're right. I do. I think when there obviously has to be some sort of incentive for the employee, so that they see, other than the fact that and retirement is an important thing. But I know when I talk to young people, that it seems so far off for them. I don't know what that would be. That would encourage them to see that this was a worthwhile, valuable thing for their future, right? So maybe, because let me ask this question. So currently, what exactly, beyond mutual funds, is that the only thing?
It's pretty much all there is. They have what are called exchange traded funds, ETFs, but those are essentially mutual funds based on a particular market index. So we are talking about a mutual fund, a situation where you have 50 to 150 underlying investments, stocks, bonds, or both in the fund, and they're usually managed by someone. And so you have immediate diversification, because you have lots of entities under that one umbrella. And most funds have, at least the ones that most plans, have 18 to 20 of those individual items that have 50 to 150 stocks in them, or 50 to 150 investments. So you're extremely well diversified in a 401k plan if you follow a little bit of direction, just a little bit.
Okay. Because I would think there's some, obviously some stock that, test of time type of stocks, have been around for decades and decades and decades that have been pretty reliable far as sustainable growth patterns. Like the I don't know, Johnson & Johnson and things like that have been around forever and ever, Procter and Gamble. Those could be enticing maybe for a young person. The crypto, no. Currently, no real estate.
Yes, you can invest in real estate in a way. They have things, they have funds that invest in real estate. They also have funds that invest in companies that invest in real estate. And you can go either way or both of those. It's more common to have investments in companies that invest in real estate.
Okay. So now, because that would be, because real estate is one of those staples, that's not gonna, it's depending on where it is, it's not gonna lose its value. Not like, depending on where it is. So even as volatile as California is, the real estate value is the real estate value. Right? It's
well said. Well said. And remember, when we're investing in our 401k plan, and I think this is a big distinction, at least in my world. Okay. When we're talking about investing in a 401k plan, it's different than investing outside of a 401k plan.
Right.
Right. So I would say it's kind of like softball versus baseball. And I'm not going to tell you which one, but just to suggest that they're very similar looking, but they're very different games.
Okay.
And so the way that you approach those games is different, right? Sometimes they have different rules, right? So for example, I had a friend that used to play softball, and it was a no home run league. You can't imagine that in baseball. But this was softball, and you couldn't hit a home run. It made the game dramatically different, right?
Yeah.
So when we look at the rules in a 401k plan, they're different than the rules outside of a 401k plan. And the reason for that is to protect the participants. So if we bring all these other types of investments in, and we take something that participants already don't pay attention to, don't invest in until it's too late, don't put enough money in, we're going to add more confusion, more unrest to the 401k landscape.
Okay.
And I'm not so sure participants going to benefit from that.
Okay. I can get it. So I see what you're saying. So, because here's what I think, because of the long-term longevity of all of this, we're not talking something that's going to turn around tomorrow and you're going to need it. It's so many years later, especially if you start in your 20s, that's 6 decades, almost 7 decades before you need it. So maybe I'm with you on it. I think it should stay mainstream so that it continues to grow at an even pace.
Yeah, I think, the problem with investing in a 401k plan, as I see it, and I'm so glad we're having this discussion because it does get us down to philosophy. The problem with investing in a 401k plan is that it's a long-term thing. It's a long-term commitment. It's a long-term entity. It's not the type of thing where you buy an investment today, you sell it tomorrow, and you make money. That's just not the way this program works. Just like, it's like in softball, you can have a no home run rule. You can't hit a home run; it's an automatic out. We're not doing that in baseball.
No.
Right? So it's different. And I remember trying to think of an analogy that would fit this type of difference. And the only thing I could come up with was that a 401k plan is a tool in your toolbox with regard to retirement savings. And the other tools that you have are your savings, your IRAs, your real estate, your businesses, everything else that you're going to use to make money.
Okay.
The 401k is just a small part of that, right?
Right.
And that part of it is it's pretty basic. It's you put money in, you wait for a long time, and you take money out. It's pretty much the way it goes. Now, when you try to game the system, right? When you try to go, well, if we put money in over here like this, we can do better and still get the tax benefit. Now we're running into a type of diversification that is, I'm going to go out on a limb, and I know I'm going to get cards and letters, contrary to the way that the 401k plan is supposed to work. Right? I said it. Okay. So, we're talking about a 30 or 40 year investment that some folks want to turn into a 1 to 2 day investment. I remember when ETFs were not allowed into 401k plans, and now they've become even more inexpensive. And so now lots of advisors are saying we should go for the ETF because it's going to save money and the participant can actually trade during the day. Well, mutual fund companies that sell retirement plans for 401ks, they got wise to that, and they suggested, hey, you can trade all you want, but you're only going to get one trade. That is, at the end of the day, that's it. You don't, whatever the cost is, that's the cost. So it does no good to trade. And then they suggested that that ETFs are less expensive because they can do that trading thing on their own inside the plan, inside the fund itself.
Okay.
The owner can do that. So mutual fund companies that have 401k plans decided we're just going to charge you a hefty fee to have the thing in the plan in the first place. So they kind of got rid of the incentive in a lot of ways for ETFs. I think those fees are coming down. I think ETFs are becoming a reality for us in the marketplace of 401ks. But the fact still remains, they're mutual funds that you can trade essentially. When we start talking about oil and gas, alternatives like options, crypto, that's a whole new ball of wax that most participants are not going to understand. The only thing that they understand about that is that somebody somewhere made a bunch of money investing in those. But what they fail to realize is that somebody somewhere lost a bunch of money before they made that investment. All right. The grass is always greener, but it's not always greener. It only looks greener. It's not always greener. There was a friend of mine.
Your eyes are not green. Your eyes are not picking up the greenness, the brilliance of the green.
Hello, something is going on there. Actually, I have a friend that would say that. She would say that because of the fertilizer, and that's all I'm going to say about that on this.
Okay.
The grass is greener because of the fertilizer. So that's what I think.
Okay.
Comments?
No, I agree. I think you're kind of spot on with that. Is the longevity. I think I think that's the key, is the longevity. And a lot can happen over that time frame,
right?
That could really, especially during the latter 4 decades, that could really upset the apple cart, right? A whole bunch can happen in the first 4,
right?
Right. First, 4, and then those last 3, or because by the time you get 70, right? 65, right. 67. That's
only like 40 years.
Yeah, 40 years. So
it goes quick.
It does go quick. 50 goes fast too. But it doesn't seem like that when you're 20, of course.
Right. Yeah, true. And then I'm sorry, go ahead. I didn't mean to interrupt you.
And then the number of times that I guess young people will change jobs in that time frame before it really gets to be serious. And I think that's probably more the reason for the hesitation than most of them, because they don't quite get it. Right. And so if I move my job all over the place, what happens to that? Do I leave it back wherever I started or wherever, or do I have to keep up with it? Young people are not all like keen on keeping up with stuff at that age.
Yeah, I think you're absolutely right. And yet, two things I want to say about that. One is young people do what we teach them.
They do.
So if we don't stress saving for the future in our high schools, in our colleges, in our universities, we don't stress how important that is and put that in a light that young people can grasp as something that's important for them to do, then we as parents, as older folks, we failed our young folks.
Right.
Because we know that all things being equal, we know that on average, you're going to make 9 to 10%. And if you do that for over 40 years, increasing the amount of money that you put into your plan, you're going to have a nice retirement. So by virtue of the fact that we as older people don't impress upon our young people how this particular tool works, we are the cause of the lack of knowledge going into that system. We got to take that. We got to say, hey, it's almost like when my niece said to me when I was complaining about, I don't know who it was, millennials or whoever it was. She said, well, Unc, you raised us. Why did you why did you raise us like that? Right? We're only doing what you taught us to do. And I had to go, oh, that hurt.
Smart woman. That would hurt.
So there's the one. However, I got to say, I'm not so naive to suggest that if we take a look at, first of all, we'd have to have really good education. But if we take a look at, okay, this is another investment account. If I see it from that point of view, it's another investment account. And so therefore, if it is, why can't we expand the opportunity of investments and let the buyer beware? I mean, there's something that suggests that, right?
Okay.
Something that suggests that. So instead of it being something that's for participants so that they can have something for retirement, it's just a way to protect investments from taxes. If we were to say that, if we were to do that, then I think we as financial advisors would have to get very good at explaining things. Because if we can't explain to somebody what a mutual fund is, I think it's going to be very difficult to explain to someone what an option is and how cryptocurrency works. Right? So, we have that hurdle to get over. And perhaps I'm a little bit afraid of that. Perhaps I'm thinking to myself, oh, I don't want to climb that hill, right? Where I have to explain to folks who really don't care how important it is to get inside this 401k plan and put their money away. Also, one of the things I'm kind of afraid of is in this industry, not everybody is, how can I say this? Not everybody is chivalrous and has the best interest of participants in mind. Some people have their interest in mind, right?
Who's that?
So at least the way it is now, we can sort of protect people from their own bad interest. We can say, look, you can invest in mutual funds. You have these rules around how you can invest, how you can take the money out. It's very, very difficult for someone to be taken advantage of inside a 401k plan. Very difficult, very difficult.
Yeah.
Bring all these other things in, and it becomes just an account. Then we have, and there's been some in the news where people have been just ripped off.
Yeah,
essentially. And I think not to like blow up and call that was a professional term. But just to call to attention that I can definitely see the understanding as to why people would want that, because people don't save enough, right? It's one of the reasons why my colleagues and I often request that when someone starts investing in a plan, that they take more risk than they thought they could, because they're not starting until they're 45 or 50, right? they're starting in their 20s, they wouldn't have to take very much risk at all. And by the time they reach 60, they'd have 40 years of fairly low risk investments and a nice pot of money that they could use to retire with. We'd have a whole new ball game. But if you're not getting into the plan until your 40s or 50s, maybe you need to take a little bit more risk than you think you can, if you can stomach that.
Right, exactly.
And therefore the education becomes incredibly important.
Right.
I think that's the real issue for me, if I was going to sum this up, and then I'll let you talk. You've been very kind. I would say the most important factor in a 401k plan, as it is right now, is education. Right? If we take away the safeguards, then we're changing the tool so that education isn't necessarily the most important tool. What becomes more important is, in my opinion, salesmanship and the ability to convince someone that this is a good investment for them. And, I just don't think that's a good thing.
Yeah, I think the education, but and that education goes a long way, because that's education in financial understanding or literacy, and I think the education is vitally important, and for many reasons. Just to be able to function in this world today, you have to understand how money is made and how money should be spent and how money should be saved. And so you're absolutely right on that point. There's so many young people who never got those lessons because their parents never got those lessons. So the not knowing is passed down from generation to generation. And I think that would solve a lot of our world's problem. Is that education piece. So there's a lot of us out there in my world that's what we're focusing on is education, understanding money, and understand how money is used over time, and leaving those legacies for our families. Because even the very, very poor, the ones that are very, very poor in our country, and some of the issues that are going on in our country, is it may not necessarily had to be that way. It's just you didn't know any other way.
Right.
You just didn't know any other way, because like you have your retirement package, but as you said, you have the ability to go out and do your own investing. And even someone that doesn't make a lot of money, you can take that extra $20 a month and invest it somewhere, and just leave it and just keep adding to that pot every month with your little extra, whatever's left over or that you don't need. Put it in something that's earning some interest, right? And so down the line, when you need that emergency money, it'll be there. And then you just have, it's a discipline thing, but understanding, instead of buying baby gifts, set up an account for someone's child starting at birth. And every time you give them money for their birthdays, that's where you put that money, right? In an account like that. And so by the time they get ready for college, so it's just and in retirement, and then you set up your refunds. I don't know, years and years ago, that was something that you did, right? The banks encouraged that. Your Christmas fund, your college fund, your whatever. Here, put this kind of money in your child savings account and watch it grow. And I think if we definitely continue to focus in that space of education, then all of this the outcome of all of this would be much better.
Yeah, I couldn't agree more. I think you hit it spot on. Back in the day, we had more of a care for in some ways, for the well-being of our offspring, rather than letting them figure things out for themselves. And, if we think about the advances in technology that have happened over the last 20 years, and how those affect the various industries around them, then we can just extrapolate that the advances in financial services have also changed dramatically, and without telling you when or why, they just happen to. So I think, I don't want to say to expect someone. However, we have a nice tool here that can help most people that get involved with it early enough have a decent retirement. Why do we want to mess that up? And I really think it's very interesting that the people that are most affected by alternatives, oil and gas as alternatives, ETFs, these inflation hedge strategies, things like that they want to put into 401k plans are business owners, right? Yeah. They're not the employees. Now, I will tell you right here and now, as someone that sells retirement plans, I try to make those retirement plans work for the benefit of the business owner because they're paying the bill, right? So once we get to those three big ones, reward, recruit, and reward, recruit, and whatever the other R is. Retain, reward, recruit, and retain. That's how we want to design that plan, sort of the business owner's business, and then they can take advantage of that, right?
Yeah.
So it is. I definitely see both arguments, but I would say as a person that's in this industry, I'm going to lean towards this being an employee benefit that business owners can take advantage of, and that we need to, instead of changing the benefit, we need to change the mindset with regard to how we educate children about saving and how important that is. And let's go there. If you can find me some tools that stress the importance of teaching your children how to save and what money is, what's a credit card, what's a mortgage, I'm all about that. Stick that in the 401k plan. And let's stop this generational poverty, right? Let's put a stake in the ground and start from here, and let's get some generational wealth going, because people understand the value of money and, most importantly, the importance of saving.
Yeah, no, I'm with you on that 150%.
150?
Because that, for more, like I said, for more reasons than just that one, that is something that we all should be focusing on, is making sure our children understand money and our generation. Heck, for some of these adults out here, they don't understand money.
You know what? I think that's a perfect way to end this broadcast. I want to say thank you, A, for the article, and B, for the comments. And let's call it in right there. I'm going to go ahead and read your bio. And I think you've given us the last word, unless there's something else you've got to say.
No, that would be it.
Okay, everybody. I want to thank you all for visiting myself. I'm Jevon Thomas at Jevon Thomas Retirement Plan Consultants. And this has been Conversations on the Patio. And my colleague and friend Crystal Mitchell has graced us with her presence. Crystal is a business coach and consultant. She's the CEO of Mitchell Business Solutions, co-director of Recycling Black Dollars. She's also the co-host of The Business Zone with Crystal and Gilbert. That's another weekly online radio show. Crystal's an instructor at Mount San Antonio Community College, a certified network for teaching entrepreneurship instructor, and a QuickBooks Pro Advisor financial strategist. Crystal, thanks for joining me. As always, a pleasure. And everyone else, we will see you next time on Conversations on the Patio.
All righty. Bye-bye, everyone.